Okay, in this video we're talking about credit enhancements, which well, may take different shapes and forms, but one of the major ones is going to be tranching, credit tranching. So a topic we've already touched on in the introductory video to this sort of this section on securitization. Right. The thing is, if you've got a single class ABS, asset-backed security, meaning that over here you've got investors, and in a single class structure, every investor who holds an asset-backed security, this is typically a so-called pass-through security, is entitled to their a proportionate share of the payments from the collateral, from the assets backing the security, share of cash flows from the collateral. Let's stop at this. From the collateral. So if you hold two of these securities, given that they've got the same class, you'll get 2 times the cash flows as you would in a single class security. Obviously, this is after any servicing or administration, admin fees are taken into account and deducted from those cash flows. And of course, because everybody shares proportionately in the cash flows being received and cash flows flowing from above, the investors are going to be exposed. Investors are exposed to the credit risk or default risk of that collateral, also proportionately. So if we don't recover 10% of the value, everybody doesn't kind of recover 10% of their value. Now the whole point with credit enhancements is they changed this, and one of the ways in which we can do this is by tranching, so creating more than one class. That's going to be the most sort of important method, which we'll spend the most time on. But just be aware that credit enhancements as such fall into 2 categories. One is internal enhancements, and the other, of course, is external. Now this second one, let's get it over and done with, because it's really quick. External credit enhancements, and we'll have a lot more to say about the internal ones, are provided by by third-party institutions. So these are typically financial guarantees. Well, how third-party that is, it doesn't really matter. They don't arise from the structure of the ABS. They come about because there is a financial guarantee provided by somebody. These are financial guarantees by banks, maybe by insurance companies, why not? Maybe there's a letter of credit, which is once again a very specific way to provide assurance that something will be covered if things go wrong. So these are the external credit enhancements. Your book doesn't really say any more about this. It does, however, have plenty to say about the internal ones. So let's make space over here for internal credit enhancements, and let me tell you what these are going to be about. Well, they come from the way in which the ABS structure is set up. So one we've already seen when we discussed covered bonds is the notion of overcollateralization. Overcollateralization, one of the longest words in finance. I guess securitization is another one, but overcollateralization is definitely longer. Okay, that's the concept of having the value of the collateral. In the case of covered bonds, that's the cover pool. Over here, it's the it's the assets that are being that the securitization concerns, being higher than the bond face value, the face value of the instrument that is being issued out to investors, and this creates a very nice excess or cushion to absorb losses, because the initial whatever certain portion of the assets losses will not hit the investors because they haven't financed the full thing, so to speak. Now, the second idea, quite similar to overcollateralization in its sort of logic, is something called excess spread. So that's once again having a bit of a difference. Here it's all about the coupon, or the interest, the average interest on the underlying collateral. Once again, think about this as for example, mortgage loans on the original collateral, underlying collateral, being higher than the coupon offered on the bonds, on the asset-backed securities. Okay, higher. So imagine the people kind of at the top of the structure, that's the borrowers who receive mortgage loans. They're paying a coupon of, I don't know, 5% or interest of 5%, but the coupon on the ABS is less than 5%, let's say 3.5% or 4%. That means there is room there to absorb some shortfall, some sort of deficiency, because you don't have to pass everything on to the investors. So once again, the idea is that this excess, the excess spread, that difference. Maybe I should have written that with a with a deduction operation with a minus in the middle. Its purpose is to absorb potential losses up to obviously some amount only, losses or shortfall, and potentially also create a reserve, which may be used in case such shortfalls arise later on, so to speak. Right, so that was the notion of excess spread. Now the third one, the one that we're going to spend the most time on, I guess, is subordination. And this is absolutely synonymous, ladies and gentlemen, with credit tranching, creating tranches so as to differentiate who gets money first, who gets money later, and not only the order, but also with it will come different yields, different returns. Okay, so this is something I've talked about already, creating absolutely more than one tranche or more than one class of bonds, and as I just mentioned, these classes or tranches, they differ with respect to how they absorb credit losses that may appear in the collateral pool, differ in how they absorb losses in the collateral pool. Okay, good. And like we mentioned in a previous video, you're going to have senior sorry, let me write that again. You're going to find senior tranches, senior classes, and you're going to find subordinated ones as well, also known as non-senior subordinated. They're also known as junior tranches. I believe I wrote some of these names down before. So this differentiation in terms of how the tranches absorb losses? Well, it comes about from the fact that it's really about creating an order. This split creates an order with which, or in which, any payments from the collateral pool are passed on and made to investors holding the different classes, in which payments are made to investors, and as a result, it also creates a hierarchy in which losses, according to which losses are absorbed. So let me just show you a very simple example of this. Most of the time, this split into senior and subordinated tranches is such that the subordinated or junior tranches, they provide protection for the more senior ones. For the more senior tranches, okay, so that losses are first, or losses first hit the subordinated tranches, losses first hit or wipe out the subordinated tranches, before they spill over, before they affect or spill over onto the senior classes, to the senior classes or their holders. Okay, and one thing you're going to get quite a lot is a structure that resembles a waterfall. Well, it's called a waterfall structure, which has a cascading order of payments. So the example your book gives is a bit numerical, although the learning outcome statement just says describe. And end of chapter questions also focus on the sort of on the understanding of the mechanics rather than performing any specific computations. So let's imagine an ABS, an asset-backed securities, where you're going to have a collateral pool, loans, and basically those loans generate some, I don't know, monthly repayments. And the thing is, we're going to have different ABSs because they're going to be broken into tranches. You're going to have tranche A, which is going to be the sort of the senior tranche in the structure. So this one is the senior tranche. Okay, you're going to have next something called tranche B, which is not senior, it's sort of in between. This kind of in between we often call mezzanine tranche, but don't worry about the names, I'm just giving you some alternatives. You'll obviously have tranche C as well, and you're going to have tranche D, and I could go on because sometimes you go all the way through the alphabet, but I'm not going to bother. That doesn't really add much. That's going to be a junior tranche, and this one is going to be absolutely subordinated. In fact, it's subordinated relative to anything else. We sometimes call this one, often call this one the equity tranche. So this is going to be the bottom one is effectively the equity tranche. It gets whatever is left, whatever is residual after everybody else has been paid off. And each one, look, the point is, each one of these tranches will have a certain, because it's effectively asset-backed securities being issued in these tranches, they're going to have face values. Just like any bond. So imagine this, this one has a face value of 50 million, I don't know, euros. Maybe this one has an FV, I okay, FV in the CFA curriculum may be confused with future value from time value of money, but let's say this one has 80 million of face value, and I don't know, this one has something like 120 of face value, and the top one is going to have the most senior one, a face value, let's say, of 150. Right, what does that add up to? 150 and 50, that's 200, 320, okay, that's nice, 400 million. Managed to get that into a nice round number. And look, the point is, what happens when the cash flows from that collateral pool are passed on to the investors? Sorry, it's my computer not wanting to draw an arched line over here. The idea is, anything that is a repayment of principal, because borrowers, who took loans also pay interest, but interest is shared between the tranches kind of in a more continuous way. But when it comes to principal repayment, so that's the repayment of capital on the loans, it is first directed at the investors holding tranche A, asset-backed securities. So their job, or their sort of the idea behind being a tranche A investor, is that these guys receive their principal first. So any money being repaid here, which is classified as principal, goes to these people first. Once they've received 150 million, so they've been repaid totally, only then is the money or the flows diverted to tranche B. So they receive principal, any principal payments, once tranche A has been fully repaid. Now, don't confuse this with the receipt of interest, because all of them kind of receive interest typically on a current basis, with the exception of, your book doesn't go into this, or at least not in this section, something called tranche Z investors who don't even receive their interest on an ongoing basis. But here I'm not kind of using that. So I guess you get the idea. It's only once these guys have received 150 million does the money start flowing to these people, tranche B, and it's only once they have been repaid do we start to throw any money at the lower tranches. So these guys receive principal, but only once A and B have been fully repaid. And it's, if you're a tranche D investor, you're only going to get money, any money coming to you in the form of principal payments, which is a return of capital, once everybody above you has been repaid. So these people, the tranche D investors, really do take the highest risk. However, look, their loss absorption capacity, so D, only absorbs losses up to 50 million. If it turns out that there is a principal shortfall, a capital repayment shortfall, and it's beyond 50 million, it means C will not get everything. And obviously these two tranches combined, that's C and D, have a total loss absorption capacity of 50 plus 80, that's 130. So as long as the money repaid here, the principal, is big enough to cover what we owed to A and B, they will be not affected. As long as the losses stay below 130, which is the loss absorption capacity of tranche C and D, A and B will receive the full money back. But of course, that's not in any way guaranteed. The higher you are in the structure, the more you are protected, because somebody below you comes first when it comes to absorbing potential losses. And you need to be able to understand this concept, who absorbs losses up to some amount, even though you won't have to do any intricate computations. Computing the absorption or loss absorption capacity is absolutely an easy enough computation for you to have to do it on the exam day. So because Tranche D faces the highest level of risk of them all, they will also be offered the highest yield. So of course they will these guys will be getting definitely more interest on their investment than, for example, Tranche A investors. So I wanted to make this percentage sign bigger, because up here you've got the loans, and they don't just pay principal, they also pay interest. And that interest is shared, but it's not shared proportionately, because in the sense that some people get more interest because of the higher risk they take, whereas others, like Tranche A, because they face the lowest risk up here, they will also receive the lowest return, because they're sitting pretty safe. They're not getting exposed to definitely as much risk as the tranches lower down. So that interest is also shared between everybody, but in a non-proportional way. It's not proportional to the face value. Okay, and let me just point out one more thing here. I'm not going to write this down. You see, when you create these tranches, what's nice about it is that investors can choose. They can choose which level of risk they kind of want to sign up for, which also means what yields they want to sign up for. And because these tranches have different expected maturities, we expect A to be repaid before B and B before C, etc. They can choose among different risk levels, different yield levels, and different maturity levels. And the point is, when you start giving investors that kind of choice, they typically appreciate it more than when you just provide them with a simple single class structure where everybody shares in the money proportionately. So providing more variety often pays off in the financial market.